Yo sambando todo.
Even though it's in the money by 50, you actually still end up losing because the premium you couldn't compensate for. You couldn't make enough money on the downside to compensate for the premium. So in this scenario, when the stock goes down from 300 to 28.50 and your strike price is 2,900, yes, you're in the money by 50. Scenario, when the stock goes down from 300 to 28.50 and your strike price is 2,900, yes, you're in the money by 50. But because the premium paid was 100, okay, the 100 per share, the net profit here would actually be a loss of $50 because you have $50 in profit, but you paid $100 in premium per contract. Since each option contract is 100 shares, that means that this would be a net loss of $5,000. So buying put options can actually be really expensive and you can lose quite a lot of money. So you want to be very careful to have proper position sizing and risk management in place, which I will talk about very shortly in this video. Actually, let's talk about it now. Now that we've learned how to buy put options, well, it's really not that simple. As you saw in the scenarios, you can not only make a lot of money, but you can also lose a lot of money. So you want to be very careful about how you go about buying options. With a put option, it's just like a call option. If it doesn't reach your strike, you lose the amount of money that you pay for the option. The good news is that, again, you can't lose more money than you pay for it, and you can recoup some of your loss or some of that premium if it goes slightly or partially in the money. So you can make varying amounts. That's where actually risk management comes into place. That's where taking profit comes into play. You may not want to hold the option until expiration. Oftentimes, when a stock moves towards my direction, towards an option that I'm buying, I will almost always typically pick an exit point. So for me, an exit point may be when I have a 50% gain, when I have a 75% gain, or maybe even when I have doubled my money. So let's say that I spend $1 on an option contract, so $1 on a buy put. If that put option now becomes worth $2 in a short amount of time, now a short amount of time just depends on the total amount of time. So for example, if I'm trading a 1-week option, then a short amount of time might be a day or two. But if I'm buying an option for 6 months out, a short amount of time may be 1 month. So a short amount of time is really relative to the holding period in general. So this is really important because this is how you risk manage. This is how you take profits properly. Is for option buying, you almost always want to close this position and have an exit plan as soon as you have an entry plan. So it's really important to understand, hey, I want to enter at this price. Okay, so you want to buy a Apple 170 put. You think Apple's going to go down. That's good. But if Apple goes down to 170, as we saw in our scenario, we may not have a profit because there's expiration. If it's only 1 week in and there's still 3 more weeks left, that's a really good move. And if it goes into 170, you're not really in the money yet, you're at the money. You can even be a little bit outside of the money on a long put option. You can be at 170 and 50 cents, which is 50 cents out of the money. However, this put option might already have a gain. If the put option already has a gain of 50% or even more than that, you may discuss with yourself and say, hey, self, I think this is a good time for me to take profits. I'm very happy with the return that I have so far. And in this case, I would say that that's fine to take your profits. You can take profits early and often. There's never anything wrong with that. So I do want to dive into some techniques that can help you limit potential losses, as well as looking at a stop loss or a stop limit order. All right, so we're going to jump into my Robinhood right now, and I'm going to show you an example of how I would run a buy put on Starbucks. Okay, so I'm going to go to trade options, and what I'm going to do right now is I'm going to pick a put option for the future. So let's say that I'm going to just go out for something like July 19th. Let's say that I think Starbucks is going to fall further for whatever reason. Let's say that I think that people are going to drink less coffee. I think that the balance sheet isn't looking good. They have a lot of debt. Whatever the case is, you want to find a stock that you are bearish on. It's also really good to find stocks that have bearish momentum on the downside. So talking about technical analysis, which, we'll get into a little bit later. All right, so let's go to buy put So we're going to go buy put, and then I am going to pick something like the 70, okay? So if I click right here, you will see that I have highlighted and the premium is $1.44. So I have to pay $144 to hedge 100 shares of Starbucks. Now remember, when you're buying put options, you can either make money on the option itself, or you can also hedge your portfolio if you already have Starbucks stock. Let's just take scenario number one, because in almost all cases, you're just buying to speculate. You're buying to make money. You're not buying to really hedge your portfolio, although you can use this, and I do have some training on this, but let's just focus on scenario number one. You're buying a put option to basically make money on the option itself, okay? So if I go right here, you can see here how at the top right, I have a few different things. I have a limit, I have a stop limit, and basically that's it for this position. So what I can do with a stop limit right here is I can trigger a limit order if the bid price rises to the stop price. So if I click right here, you can see here now that I can set a specific stop price. Okay, so in this example, I can go and I can type in, let's say 1.42, and then for the stop price I can say, hey, I want to be stopped out at X price. Now I'll be completely honest with you, stop prices and just in general, let me go to another limit order. So you can also do a limit, so you can buy order at a maximum price or lower. So you can say, hey, let's say it's at 140, I want to buy it at 130. I don't want to pay more than 130. In that case, when you set a limit, you actually won't get executed on this trade at all until it reaches that 130. So you can say to yourself, well, I'm only willing to pay X amount of dollars. You can set a limit order. You can also set a stop limit, basically saying that, hey, I've made X amount of profit, I want to stop here. And Robinhood or any brokerage can trigger a specific order to actually get executed at a different time based on a price that you pick. Now, I'll be honest, I don't typically do this, and you can do good for a day, you can do good till cancel. You can basically have these orders automatically making money for you. Say that you're at work, you're busy. You can say, hey, I want to get in at this price, I want to get out at that price. So you can set predetermined prices for yourself in the future. However, I will say that or stop loss orders, but more so limit my position sizing. So position sizing is the most important thing. You can have some losing trades if the position size is small, it doesn't really matter. And if the position size is really big, that can be the end of your portfolio. So you really do not want to do that. And you can take an example like losing weight. You can have a little cheat meal here and there. You can have a cookie, a snack. But if you end up going on a binge eat and you eat a whole cake worth 10,000 calories, that's going to set you back. The same thing with trading. If you end up making one bad trade, it can set you back quite a lot. So you want to make sure that you have proper position sizing, which for me can be anywhere from 1 or 2% of your portfolio for option buying. Now, when you're option selling, it's a whole different game. I have lots of videos on this YouTube channel talking about option selling, which is primarily what I do to make currently around $80,000 per month selling options. So that's what I do. But when it comes to buying options, you want to be a lot more conservative, a lot more safe. When buying a put option, you honestly want to have a small position size, like I said, but you also want to really limit it to 1, 2, or 3 contracts. Or if you want to protect the position that you already have, a put option can perfectly get you out of a position you already own, because you get to pick a strike price and basically exit a stock at that strike price, however many shares you have. So if you have 200 shares, you can buy 2 contracts. Again, this gets a little bit more complicated, and that goes into the hedging territory of using put options. You can simply just make money by buying a put option and selling a put option as it makes money. Selling puts is by far one of the best, safest, and most consistent strategies to make weekly income in option trading. This step-by-step guide will help you better than any other video, and I'm going to be showing you proof. If you know the right time to sell puts, you can collect a ton of money from premiums with very little risk. So first, I'm going to explain to you very simply how selling put options works. Then we're going to get into the stocks and indicators that I look for when I'm about to sell some put options. And lastly, to show you real life proof trading so you can get examples and see how I do it in my own portfolio, I'm going to be doing some live trading and collecting income, and you'll be very surprised how much money I can make in just 20 minutes. I'm going to be selling puts live. I'm going to see if I can make $5,000 or ideally even more than that in this video. Let's keep track on the bottom right somewhere here, and let's get educated on consistently making money option trading. So get ready and let's flood your pockets with some money. Firstly, there are 2 reasons why you're going to want to sell put option contracts. 1, to generate income, and 2, to buy shares of a stock at a cheaper price than you can normally get them on the market. Imagine that a stock is trading for $165. you can buy that stock cheaper than the current price of the market. To this strategy, which is actually my number one strategy. A put option is simply a contract between the buyer and the seller. The buyer of the put option will have the option to sell 100 shares of stock to you as a seller at the strike price. And of course, you can pick any strike price you want to potentially buy the stock at that strike price if you do get assigned. So keep in mind that you want to be comfortable with buying 100 shares per option contract of the stock that you get to choose. You are in full control, but you must make sure that you do like the stock, because if you get assigned, you will own 100 shares. So selling puts can be expensive because this is one of the strategies where you do need to have 100 shares of capital ready to go. So if you have a small portfolio, you will have to stick to cheaper stocks such as HIMS, Palantir, NEO under $5 of course, American Airlines, and, well, other stocks that meet your portfolio size so you have proper position sizing and you don't hinder your risk management. And the best part about this strategy is that you'll get paid to sell the option to the buyer. At worst, you will buy the shares for cheaper. In either way, your cash will grow in your account. Remember, the buyer has to pay you a premium to have the option to sell shares to you at that strike price. The option buyer is paying to have that right. Here's an analogy to help you out. Puts are basically like you're an insurance company. You are charging a premium for the risk of the stock falling down and you having to buy that stock at that strike price. You are becoming a mini insurance company that can print your own money in the form of premium that you are collecting. The way it works is you collect a bunch of money up front when you sell a put option, and some of the trades you will lose. Again, we can't be perfect here. I'm not perfect. I make mistakes all the time. And just in trading, if you have a high win ratio, you win more trades than you lose, you will come out profitable. So in this example, what you want to do with this strategy is you will be collecting money up front. Some of the trades you will lose, but your winners will far exceed your losers if you follow my step-by-step instructions, as well as learn from the live trading that I'm going to do shortly. So let's use some real numbers to help you understand. Microsoft is currently trading at $410 per share right now. Let's say that you think Microsoft is at a low right now and you don't think it's going to go much lower in the next 30 days. So what you want to do is you want to sell a put option contract on it. You pick the strike of $405, which means if Microsoft does happen to fall below 405, you have to be comfortable to buy 100 shares at that price. But you won't mind that because you think Microsoft is going to be going up. You love Microsoft long term. You think that it's at a pretty good low, so you will be happy to buy it at 405. It's currently at 410, so you're going to get paid to buy it for $5 cheaper than where the market is at right now. Seems pretty much like crazy, right? Like, why would someone do this? Well, someone else out there in the world thinks that the stock might go down a lot lower. They may be right or they may be wrong. Either way, you are happy making this strategy in this trade. And let's open up Robinhood and see what I would actually get paid if I decide to sell the put option. So let's pick a strike price of 405. All right, so I'm going to go to trade options as I usually do, trade options, and then I will go for something very short term. So I'm going to go very short term here. We'll go actually to... Now, we'll give it a little bit of time. So let's just go to the end of the month, which is just a couple of weeks. So if I go to the 405 right here, you will see that the premium collected is $4.80 or $480. So right here, I can actually make a 1% return. Now, I know this is 1% because I'm putting up 405 and then 1% of 405 is going to be about $4.05. So there's actually over 1% return. I'm getting paid over 1% in under 30 days to buy a stock that is going to be a very good buy at 405. In fact, this is actually under 30 days. If I were to go to about 30 days, I would be a lot closer to actually almost 2%. So you can see right here that it's actually $7.05. So if I were to execute this option, one contract here would give me about $705. Actually, you'll see here that I was actually on buy a put option, but I need to be on sell. So actually, the price will be a little bit different. It's going to be $615, which is still amazing. I noticed that because I saw there was a max profit, and that was a bit weird. And this strategy actually has a max loss. Although the max loss here will look extremely scary, you might be thinking, just, oh my goodness, why would you ever collect $615 with the max loss of $39,000? This max loss is actually, it's not really correct. In theory, it is correct, but what it means is, if Microsoft went down to zero, you would lose $39,000. I don't know about you, but Microsoft is not going to go down to zero. I think the world has to literally end for the stock to fall that much. There is no way a company the size of Microsoft will go bankrupt. There's actually almost no way the stock will even fall 50%. Yet alone, in most years, it doesn't even fall 10%, or it doesn't even fall at all. The stock is rising, right? So although the max loss is very scary, this is the equivalent of you getting into your car and the max loss says, well, you may not live today. So, yes, that's scary, but most people still have to drive to work. We still have life to live, and we still take that very, very small risk to go into a car every single day. It's the same thing here. So it has a very big max loss, but in all reality, this is a very, very safe trade that I've been doing for the past 10 years. I've worked for Goldman Sachs as well as a couple other hedge funds. I have a degree in this. I've sat with many experts on this. I've talked to many financial advisors. I've talked to hedge fund managers. This is a very standard, easy strategy that basically every single person in the world does. I've seen billionaire portfolios as well. This is just a typical strategy that they are using. So basically, let's do some scenario analysis. If Microsoft goes up to, say, 420, you're totally safe. You're going to be making money. If Microsoft goes up to anything, really, if it goes up at all, you're going to be making money. If Microsoft actually goes down a little bit towards 405, you're still actually going to make money as long as Microsoft stays above 4. Now, at 405, if Microsoft were to hit 405, you would now be in assignment territory, meaning that you will get assigned at expiration if it's in the money. However, you still made a gain because you are collecting $6.15 here, okay? So we have $6.15. So really, if it's at 405, you're good. If it's at 404, you lose $1, but you still collect the $6.15, so you are still positive $5.15. In fact, your break even here would have to go 405 minus the premium that you collect. So the break even here would be $3.99, or actually $398.85. I'm doing the math in my head. So at $398.85, that's your break even point. Okay, you will be buying Microsoft at 405 or below, but at $398.85, that's actually your break even. So if it goes lower than that, you will be at a slight loss, even considering the premium that you collected, which is totally okay because you may deem to yourself that I want to go see shortly. I'll make trades that look very similar to this. So, if Microsoft goes down past 405, you'll have to buy 100 shares of Microsoft, but that's not even that bad because you want to own the stock anyways. But how do you know if a stock is not going to go down? And that's by using some simple things called technical analysis. Technical analysis can make or break your trading success. It can make you either very profitable or it can make you a loser in option trading or any type of trading really. So technical analysis is simply just analyzing the price movement of a stock using multiple tools that I'm about to cover and show you real examples of. So many great option traders, I've worked with many of them, have used technical analysis to a great extent, including myself. I use technical analysis to accurately predict where the stock price of a stock is going to go. Now, this isn't perfect. Nobody really knows where a stock is going. In fact, there's a famous book out there called The Random Walk Down Wall Street, which discusses stocks being completely random and not having any clear direction where they're going. Now, that book is not completely correct, but it's also not completely correct to understand or to say, I know exactly where the stock is going to go. That's a complete lie, and almost nobody can do that. So I'm somewhere in between. I think that technical analysis is very, very helpful. It gives you a very good sense of where a stock is trading at and where a stock is likely to be in the future. Now, short-term trading is very difficult, which is why I personally prefer I'm going to show you all the strategies that I know around technical analysis. And I've said this many times on my channel before. My favorite 3 technical analysis tools are RSI, moving average, and Bollinger Band. The first one that I'm going to teach you is called moving average. All right, so now we're going to be looking at Amazon stock. I'm going to be using Amazon to give you some technical analysis. The first thing that I'm going to do is I'm going to go to the charting feature on Yahoo Finance. Yahoo Finance is free, and I absolutely love it. So I'm going to get rid of currently what I have going on here, and we're just going to analyze the stock, looking at it without anything, without RSI, without Bollinger Band, without moving average. I'm also going to clear up the drawings just to give yourself some understanding of where the direction is headed. So if I look at the 6-month chart right here, starting off with actually some lines, you will see that the hardest bottom here, the hardest low of the 6 months is right here at around $144. So if I click right here, you can see that that trend has actually been very consistent with going up. Now, typically I like to go for another bottom. So you can see here that this was another strong bottom. You see there's a very good, strong momentum. Okay, momentum is really important because when I was working on Wall Street, one of the analysts that I worked with, which was a quantitative finance expert, he was looking at mathematical models. He simply told me that momentum is one of the strongest factors. And if you look at a 6-month chart, if the stock is moving up, it's likely to continue moving up. It's crazy how simple investing is when you really think about it, but that predictor right there, the 6-month chart, was actually explaining 80% of his returns. So basically, this one indicator right here will give you 80% of the potential returns that you can get from all indicators out there. And once I teach you the rest of the indicators, you're going to be in a really good position. So right here, you will see that you can go from a bottom to another hard bottom here. Like there's a big bounce here at the 155 level, or you can even go longer term and go for another hard bounce here, which happened at 173. So you can see how Amazon is in a very strong trajectory going up. And that's why right here, this would have been a very good indicator to buy the stock because, you know, we had a double bottom here. Okay. This was a very good indicator. You can see there's a double bottom. You know, bottom and bottom, and this is basically a flat. This is basically flat right here, okay? So Amazon, a tough time if you had bought at 180 for a little bit. It has proven to be a very good entry signal, okay? So I would have probably bought right here because as this was bouncing up, I would have bought somewhere in between, somewhere maybe around 175 area. I would have had a signal to buy. Now I'll show you the other indicators I would look at, but this would be a really good purchase based on this. You know, this is actually a triple bottom pattern. Now, this is some simple line charting that you can use to understand where a stock is heading. The next one that I like to personally use is I like to go to indicators, and the most simple one is moving average. Now, you can use different moving averages. You can go for a 30-day moving average, you can go for a 60-day moving average, you can go for a 90-day moving average. I actually really like to use Yahoo Finance default. The reason for this is because the most common default is 50 on Yahoo Finance. That's what a lot of other investors are using since so many people are using Yahoo Finance. So I like to keep it at 50 days. It gives me a really good understanding of where the stock is. So if I go to clear the drawings, you will see that this purple line right here is giving me the average 50-day price. So in the past 50 days on average, where has Amazon been trading? You can see here how it's consistently moving up, and that's because Amazon as a stock is consistently moving up. As long as it's staying above the moving average, this tells me 2 things. If the momentum is strong, I want to be in this trade. I want to ride momentum. I want to go with the wave, okay? I want to move with the motion. It's much easier. You probably heard this quote before, but a rising tide raises all boats, okay? It's really easy, or it's just how it works. When the tide goes up, the boats go up, okay? That's what you want to do when it comes to stock market investing. When the market is trending upwards, it's a bullish market, you want to ride that bullish momentum and make money. And that's actually where I prefer buying call options. Now, if it goes below the moving average, this is really interesting because this can tell you that momentum has shifted. But although momentum has shifted, there was 2 hard stops right here. So this should tell you actually Amazon is going for a good value because historically it is above. In the past 50 days, it's above this price, and now we're currently below, so 173 would have been a fantastic entry point. If I zoom out right here, you can see that basically Amazon has been completely trending up. So we're going to go over a different example when it comes to technical analysis, but I want to show you a couple more of the tools that I use, okay? Next one I use is going to be a RSI, okay? This right here I'm going to use for 14 days. It's the Relative Strength Index. It's basically telling you based on volume, based on how much people are buying up this stock, where is the stock on an overbought or oversold basis, okay? At 20, this would be oversold. At 80, this would be overbought. We're currently sitting at 61. 50 would be very neutral. 61 means that this stock is heating up a little bit. It's heating up. There's a lot of people buying it. Maybe it's becoming less of a good value stock to buy right now. Before I go into Bollinger Band, I do want to look at a different scenario. So I'm going to look at a stock like a Tesla, because Tesla has had some volatility and I have actually bought it very recently. So you can see here how Tesla is actually now consistently below the moving average. So if I go to, let's go to 3 months here. Tesla is below the moving average. Here it had a really sharp decline. And here you can actually see on the RSI, it actually became very low. It almost hit 20. It almost hit oversold. But you can see here how it was 24. And because it was so low, this was a fantastic time to get into the stock, because low RSI says that the stock is oversold. Too many people are negative. There's too much skepticism out there. This is a fantastic time to do the opposite, to be a conservative investor, to go against the grain and to make a decision to buy. So this right here at 140 was actually a price that I didn't get it at 140, but I started buying it at 150. I had 150 sell puts, by the way. So you already know right now what a sell put is. So I've sold puts at 150, and that's because I wanted to buy Tesla for $150. So now I'm actually very happy because I got a sign for 150, and currently the stock is at 184. So I ended up making really, really good money, like 20% return in like a month. So it was actually phenomenal decision to sell puts. So yeah, so what I would look at right here is we're below the moving average, and now Tesla has popped up above the moving average. So now we have strong momentum. I would still jump into this stock right now, and I would use some option strategies, and I would use a bull call spread, which we will talk about later in this course, because when it comes to buying options, there's some really interesting strategies that you can use. We can put up a very small amount of money and get a very big return. So I would use some different spread strategies on Tesla. Actually, how is able to go 1 year from $100,000 to $700,000 back in 2021 was I was using a lot of spreads and a lot of small account strategies, which you will learn about on Tesla. I saw there was a lot of momentum. I traded Tesla very heavily, and I made $100K into $700,000. I made $600,000 that year. It was a fantastic year, and it was a lot of Tesla trading as well as other technology companies as well. So with that being said, you now understand the simple use of RSI. You understand that towards 20 is a good time to buy. Towards 80 is a good time to sell. You understand that moving average just gives you a general idea. 50 days. By the way, you can also change moving average from 50 days. You can change it to 90 days. So for example, I can click 90, and you will see here how this is a much more smooth line, because now it's taking a 90-day average instead of a 50-day average. The next thing that I want to talk about is the Bollinger Band. So if I go to indicators and I go to Bollinger Band, you will want a period of 20 days, which means that Bollinger Band is going to predict the next 20 days. And the standard deviation is 2, okay? You'll see here 2 is fine, okay? So how this works is, this is a statistical model. It's very simple, okay? So if I click save, you will see here that we have an idea of where the Bollinger Band, where Tesla will trade, within what range. Okay, you can see that the top of the band is going to be 196. The bottom of the band is going to be 139. 2 standard deviations means about 95% of the data. 1 standard deviation would be 68%. 2 standard deviations is 95%. 3 standard deviations would be 99%. It's a bell curve, okay? The way I explain this is, if you are a man, you are 5'10", and you have a son, your son will be about 5'10". That would be the middle. That would be the average. Your son would be about your height. Okay, that would be very high certainty. Okay, now if your son was 6 foot tall and you're 5'10", that would be towards this area. You would have maybe 1 standard deviation move. If your son was 6'3", this would be a 2 standard deviation move. And for your son to be 6'5", this would get into the territory of over three standard deviations above normal. So it'd be very unlikely, although possible, extremely unlikely, that your son is going to be a lot taller given your genetics, okay? So bell curves are done with weight, with a lot of physics, a lot of statistics, height, nutrition, a lot of different areas use bell curve. It's just a very easy statistics, okay? So that's what this means. So if I go to Bollinger Band right here and I change this to 1, you will notice that this got a lot smaller, okay? Because now we have some unusual movement, because this is a little bit less usual than a 1 standard deviation move. Now, if I do a 3 standard deviation move, which gets into really rare territory, okay, you will see how now the Bollinger Band has expanded. It has expanded to 210 on the upside and then 124 on the downside. I stick to 2 standard deviations because that captures 95% of the data. It gives me 95% certainty that an option will be in that price range, okay? So if I go back to 2, now I'm going to show you how I pick strike prices when I trade options. So if I click 2, you'll see here that if I were to do a covered call, I would sell a call option at 196. If I were to sell some puts, I'd probably want to go down a lot lower. Now, obviously, I can't go down to 139 here in the Bollinger Band because that would be just too low. There's no premium there. That's too far out of the money. But I would certainly want to go at 167. I would pick 167 to pick the middle of the Bollinger Band. So use the Bollinger Band to understand the different scenarios where a stock can go, whether it's up or down, and then pick the appropriate option strategy based on the Bollinger Band. So for me, I like to keep it as simple as possible because, I am working with a lot of beginners and I focus on helping beginners get into intermediate or advanced option trader territory where they can leave their 9-to-5 job and actually do this for a living and have a lot of flexibility in their life like I have. All right, so now I'm going to teach you some metrics that you need to pay attention to when looking at what option contracts to buy or sell. All of these things that I'm about to teach you are going to be extremely useful when you're analyzing how safe an option is. The first thing that I want to talk about is called implied volatility. Implied volatility is usually expressed as an annual percentage, and what percentage reflects the magnitude of how much a stock is expected to change in either direction for that given year, up or down. And people get confused over this term because it can look confusing, but it's actually very simple. We know that volatility means how much a stock price moves up and down. If it moves up and down a lot, that means that it has high implied volatility. If it doesn't move a lot, then it has low implied volatility. So ask yourself, do you think Coke has high or low implied volatility? Well, the answer is Coca-Cola has low volatility. If you look at something like a GameStop or AMC, when things were going crazy and parabolic during those times, those were high volatility stocks. Implied volatility just refers to how volatile we expect a specific stock to be, and to measure that, every stock is assigned an implied volatility percentage. This can get really overcomplicated, and all you really need to know is that anything above 50 is a high implied volatility, generally speaking, and anything close to 100 is extremely high implied volatility, meaning the stock is expected to shoot up or down a lot. Typically, stocks with extremely high volatility, these may be biotechnology companies that have some big events coming. This may be really hype meme stocks that have some news coming. This might be stocks that have had a short squeeze of some sort. So, for example, if you remember what happened to GameStop back in 2021, it had a really high implied volatility right before the stock skyrocketed, and then it plummeted back down. So how does this apply to option trading? Well, stocks with higher implied volatility are going to have higher premium. So even if there are 2 different stocks at the same exact price, the premiums on them could be very, very different. And if one is expected to be more volatile, the premium on the more volatile stock will have more premium. Implied volatility is also very interesting because when you're screening for stocks and you're looking for good stocks to buy, so for example, I do use a software called OptionsFi. When I'm using a software like OptionsFi, they're screening for high implied volatility stocks. The reason why I like high implied volatility stocks is because I'm typically an option seller. So when I'm looking to sell options, I do want higher premiums. If I'm looking to buy options, then I want lower premiums. The next thing I want to talk about is the Greeks. So the Greeks are very important. It sounds a little bit confusing, but the Greeks basically explain how an option behaves, okay? So if you have no strategy when going into an option trade, or you do very little analysis and wonder to yourself, well, how would I lose money here? What if the stock goes up by $1? How much will the option change? The Greeks actually explain this. So the Greeks in option trading consist of really 5 of them. You don't need to know all 5. I'm going to go over them very briefly, but the first one is the most important one, which is delta. Okay, so delta actually explains a couple of things. Okay, first of all, if you look at delta, it explains the chance that the option will be in the money. So if you look at an at-the-money option, let's say a stock's at 100, you look at a $100 covered call or a $100 put, it's going to be 50 delta because there's a 50-50 chance that the stock is going to be about the same price as it is right now. If you go for an out-of-the-money option, okay, it's always going to have a lower delta because it's a lower chance than 50%. So it's going to have a lower delta. We use the 5 Greeks basically to help measure and predict the price movement of an option premium. Now, as I screen record my phone really quickly, you can see on Robinhood that we're going to look at some of these Greeks and we're going to go over them and what they mean and how to actually use them. Okay, so I'm looking at Microsoft sell put 415 for June 14th, the previous example that we were looking at earlier in this course. So you will see here that the delta is 0.48. That means that that this option has a 48% chance of expiring in the money. Now, delta also means that if the stock moves by $1, this option will move by 48 cents. So that's exactly what it means. There's two definitions for delta. Those are the two, okay? Gamma just changes delta, okay? It's not as important as delta because you can see here how the gamma is really small. Theta is kind of important. Theta tells you how much this option is decaying per day. So you can see here that it says 0.1177. This means that this option is losing about $11 per day in value. If you're an option seller, that's a good thing. If you're an option buyer, well, that's not really a good thing. Vega also, it is somewhat important, but honestly, it's not that important because Vega just measures volatility. So if volatility changes, then the option will change by, 0.53 cents if it moves up in implied volatility by 1%. But, typically implied volatility is changing, but not by too much. Although Vega is more important than Gamma, it's not necessarily more important than Theta. They're about the same. Rho is interest rates, which are completely useless because interest rates are not changing by much at all. So if I were you and you want to look at the Greeks, just simply focus on delta. So delta is the most important one. Delta measures how much the premium price of an option will change for every dollar the underlying stock price moves. So for a call option, this can be anywhere from 0 to 1. And for a put option, this can be anywhere from 0 to -1. Again, not a big deal. Well, if the stock moves up by $1, then this option will increase by 50 cents. So it'll be from $3 to now $3.50. If it moves up by another dollar, then this will again move up by 50 cents. Now, like I said, theta is really interesting because when you're an option seller, you can actually take your theta and see how much money you're making per day. So let's say that your theta is 10. Well, then you're making $10 per day on that option contract being open. So if you have many trade options, is I have a bunch of positions open, I have maybe 20 positions, each of them might, have a theta of 30 to 50, and voila, making well into the five figures or the multiple five figures per month in option premium. When options are closer to the money, they tend to have much more higher rates of theta decay because they're right at the edge of either being valuable or being completely worthless, depending on the stock's price, the strike price. So, when options are close to the money, the theta is going to be higher.
We've finally reached downsizing time.
I need to do the buying a house, selling a house dance. Not to worry, you could try to negotiate a flexible possession agreement. We don't have to move into our daughter's guest room. She'll be so crushed.
Honey,
Expertise is one of the many ways an agent who's a realtor works for you.
Higher, which is kind of fun and kind of cool, but also more dangerous because the delta will be higher. When the delta is higher, that means there's a higher chance of you getting assigned, whether it's selling a put option, it's closer to the money, or a covered call, it also is closer to the money. So with that being said, let's just get into some real examples and let's show you exactly how I'm going to make some money in this video. All right, so now is the part where we see how much money I can make by selling options. We're going to keep track of it on the bottom right or the bottom left. As I make every trade, we're going to be adding this up. So let's see exactly how much money I can make in the next 10 or so minutes, all right? So the first thing that I want to do is I want to look at Google. Google is one of my favorite stocks. I'm very bullish on Google. Now, in the past 3 months, the stock did go up about 15%. I am going to be looking at technical analysis as well. I'm going to be showing you what I'm looking for technically when I am placing a trade, like at what strike do I pick it, why, and all that whole process. So this is going to be like the most valuable thing that you can see because I've been doing this for 10 years. That's exactly how I make my decisions. So if I go to Google, I go to charts. You can see right here, I'm going to get rid of these quick lines. These were drawn. So you basically, at the more higher end of its range, it did have an overreaction here and it had a pullback. However, you can see that the Bollinger Band right at the middle is 161. Now, the RSI is not very high, but it's also not very low. It's at 63, which is a little bit higher than average. So this is actually a perfect candidate for selling a put option. Not that it's perfect for selling a put option because it's a little bit higher, but it's perfect because I don't know when Google's going to pull back. And if I want to invest in Google today, selling a put option is much better because I'm getting a cheaper price than what the stock is at currently. The stock's at 168 as I make this video. I'm going to sell a put option that is going to be towards the middle of the Bollinger Band of 161, 162. So I'm just going to go for 162.5. Now, I am going to pick an expiration date that's going to go out at least 30 days. This strategy is a little bit more boring. It's a little bit more chill. It's a bit more relaxed of a strategy. The whole goal is just to collect some income, be hands off, and be very passive with it as well as safe. So I'm going to go for June 21. It's going to be about 5-6 weeks from today. Making this video, I'm going to go to sell put, and I am going to sell a put option for the 162. So I don't want to be too heavy on my exposure. So I'm going to probably go for a contract size of about 5. So I'm going to risk quite a bit here, and I'm going to collect $1,500 on this trade. I'm going to go for a bid price of 305. Now, I will be honest with you, I could put in 3.1 I can start playing around and waiting, but for time purposes, I want to be very efficient with this video. I want to respect your time. I'm just going to go for 305. But if you want to make some extra money, you can play around with the bid ask. I could have asked for 310, and I may have actually gotten filled for 310. So that's kind of up to you. So far, we've made $1,525 so far by selling a put option on Google. Now, one of my other top plays is American Airlines. This is a much cheaper play, specifically because American Airlines is about $14 per share. Now, this is my top play in my Discord, but right now I'm a little bit upset because as I'm making this video, I'm literally like 2 hours too late because the stock is skyrocketing. I have shares, I have covered call, I have sold a put option, but it's a little bit frustrating to see the stock go up because basically when a stock goes up, the put option premium goes down. It becomes less valuable because, as the stock goes up, it's becoming further out of the money. So right now, what we're going to do is we're going to go a little bit riskier. I'm going to show you a little bit shorter term of a trade. I'm going to go for the 14.5. Again, my goal is to actually get assigned. I do want to get assigned. If I don't get assigned, that's fine. I collect income. If I do get assigned, that's also fine with me because I still get to collect the income, but now I have the shares and I can run something called the wheel strategy, which we will cover later on, or, check out my channel for the wheel strategy. This is a very powerful strategy. So I'm going to go for selling a put option right now. I'm going to go for, since this is very cheap, I'm going to go for 20 contracts here, okay? So I'm going to go for just $17 per contract, and this is hopefully going to get filled for me since I did go towards the bid price. There you go, I got filled, so I made $1, so we're going to add that to the bottom of how much money I have made. So that is the second trade, which is going to be American Airlines. By the way, the reason why I like American Airlines so much, I didn't show you the technical analysis. I've been literally trading this since I started my program back in 2021. So it's been 3 years since I've been running Discord, and I have been literally trading American Airlines since the very beginning. And it's because American Airlines has some of the most consistent returns. The stock doesn't actually move up or down a whole lot. So over the past 1 year, you can see how it actually started at 1402, now it's at 1461. So over a whole year period, it has gone nowhere. It's still at exactly where it has been, which means that there's a lot of volatility, but really no direction. So when there's no direction, that makes a perfect candidate for selling options in general, because options love volatility. And when you're selling options, you hope that there isn't any big moves typically. So this is a very profitable strategy that I've been running from the very beginning. And the reason why is because right here, we're right in the middle of exactly what American Airlines has been historically valued at. So it's unlikely to get a whole lot cheaper. It's also unlikely to get a whole lot more expensive. So selling options on American Airlines is my top play right now. That's why I decided to just sell 20 contracts. Now, I do have some more contracts actually in my portfolio. I have 35 contracts, 30 more contracts here. So keep in mind, I do already have some of this position. Now, we have done Google. We have done American Airlines. I'm also going to go ahead and do Apple. Apple's having a little bit of an intraday move where Apple pulled back, and I really quickly want to sell some put options on Apple. Now, I already have a pretty big position on Apple, but I'm going to sell some put options and show you that it is okay to have big positions on big, high-quality companies, especially companies that you have a lot of belief in. For me, Apple is my top play. I was just listening to Warren Buffett have his discussion on Apple. They had a little bit of a cut. They had some sale at Berkshire Hathaway where they did get rid of $100 million worth of Apple, but he had stated that that's just because of rebalancing and other things that are very normal. He didn't actually lose his confidence in Apple. Now, what I'm going to do is on Apple, I'm going to go out for June 21. Actually, I can also go really short term. So again, if you're watching this in the future, just go for something short term, it's fine. You go for short term or longer term, you actually get compensated in proportion to the amount of time that there's expiration. So whether you get paid $1,000 a week or $4,000 a month, it's basically give or take the same thing. So I'm going to go for a sell put. I'm going to go for the 177.5 strike price. My average cost right now is 182. Intraday, actually, Apple was above my average cost, and now it's it's a little bit below. 177.5 is perfectly reasonable for me because I'm actually going to be dollar cost averaging and getting a better price. I'm going to be reducing the price that I'm paying per share that I paid in the past. So for me, it's a good decision. I'm going to go ahead and sell 10 contracts right now. So I'm going to go for 10 contracts, and I'm going to execute this for $1.12. So I'm going to collect $1,120 right now. And boom, we just got filled. So that's amazing right there. So we got filled for Apple. So we're going to add that to how much money we have made. Now, the next stock that I'm going to trade is going to be Amazon. I already have Amazon. It's actually above my current average cost by quite a lot. I'm up 37% on it. I do have some covered calls, and I would not mind having a little bit more Amazon. So I'm going to double down. This is something that I should have done a very long time ago, but I'm going to finally double down on Amazon, and I'm going to sell some put options. Now, if we take a look at Amazon technical analysis, is going to be important. I've actually shied away from selling put options on Amazon because I was a little bit concerned that the stock was kind of hot. So indeed, I was kind of right. We had a pretty decent sized pullback. However, what I was wrong about was not that I'm good timing. No one's really good at timing the market. If anyone says they're good, they're completely lying. I didn't time this well. So I kind of missed the boat at 175.